Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these videos for trading purposes. They're for information only. Start here with the weekly chart of the S&P 500 going back about 6 years. Gives us the big picture. There's the COVID sell-off and then the 2022 bear market, and then nice rally that we've been having here. 24, we've had a couple of rocky moments, but again, we're pushing to all-time highs right now. As I've pointed in other previous videos, we're just in a nice uptrend, and so staying invested for the time being, at least on our long-term money, certainly. We go down here to a daily chart, gives us a little more info on what's going on here last couple of years of trading. And you can see here through the summer, we've had a couple of pullbacks, a little consolidation. I drew a triangle here, and we kept bumping up against those all-time highs. We've since gone through it and seem to be pushing on. So again, we're above all our significant moving averages. We're just moving on to higher, and after a period of a couple of months, even if you include this April area, maybe say, hey, 5-6 months we went sideways for a bit. Well, we're moving on to all-time highs here as the year envelops. Go down to even a little more detail. I didn't get these updated, but you can see here the trend that's going higher. This gives last 6 months trading on the S&P 500, and we are just pushing to all-time highs, even with a couple of little pullbacks. It all looks pretty strong. From the internal measures, if we come down here, we look first. This is the bullish percent of the S&P 500. This is the percentage of the S&P 500 that's in an uptrend, and currently it's at 77%, which is a good number. It means your broad market actually is still rallying. Some stronger than others, obviously, but it's gives us a good measure of, hey, is it just 5 stocks that are holding up the index, or is it really a broad-based rally? And so far, that's looking pretty broad-based, actually. Below that's the advanced decline line right here. It's not strong advancers over decliners, but it's still positive. There's nothing untowards sitting there. And if we come down here and look at the VIX, the volatility index, sitting right now about 21, which is a little bit elevated. Normally you might see it at 15 when we're in a full rally. We're going to all-time highs, but this reflects what people are paying for so-called insurance in the options market on their portfolios, and it is a little high, but nothing. When you see these spikes like this in a sell-off, that's when you worry, but nothing too troubling there as of yet. We come here to interest rates, the 10-year interest rate on a U.S. Treasury bond. You can see here we've been the last couple of years in a sideways pattern, right around between 3.5%, and we're at 5 on the top, but looks like between 3.5 and 4.5, we've just been staying in that range. It is moving a little bit higher recently, and that may be why the VIX is a little bit elevated, because as rates move higher, it's generally not positive for the stock market. And as that happens, and we're sitting at all-time highs, that's a little nerve-wracking, but I'm really not seeing any evidence right now that we should be running out of the market. It's just not showing it, and tend not to argue with the market at all, and just follow along with what we're seeing. We go next to the economy. We have the GDP growth rate. It's about 3%. We're actually seeing some decent growth here, and even non-farm payrolls, the jobs numbers are all strong. And if we come down here to retail sales, it's pretty weak. Not fantastic, but nothing to see here that's too concerning. Even the inflation rate, we're 2.5. Nothing there that's really too worrying. And then if we come here to the forward earnings for the S&P 500, this is what analysts believe earnings are going to be going out forward. You see this is Q4 of 25, so a year from now. They're still portraying really positive earnings for the S&P 500, so nothing too much to worry about. My only worry, as we have gone forward, and I've shown this before, is this reflects the price to earnings ratio of the S&P 500. And you can see this is the price of the S&P 500 here. And down here is where the S&P 500 would be if we were at 20 times earnings, which is probably what most people would consider reasonable. Right now, I mean, you're pushing soon, getting to double that. It's definitely in an overvalued area. But as long as the earnings continue to rise, the earnings could come up to meet that level. But I'd certainly say that the market is fairly expensive at the moment. So for the time being, again, everything looks fairly decent. The economy, the earnings, the trend. We always just try to follow the big trend in the market, and all of these things are positive in the moment. So staying invested and going forward. So hope this was helpful and informative. And if you have any questions about how we're running portfolios for clients, please don't hesitate to reach out. And thanks so much, and we'll see you at the next update.